Lesson 7. Dollar cost averaging versus lump sum investing. When it comes to investing in the stock market, the major distinction between dollar cost averaging and lump sum investing is when you invest in the stock market. Dollar cost averaging involves investing little sums of money at regular times throughout time. Lump sum investment, on the other hand, is when you invest all of the money you have available to invest at the time. Dollar cost averaging. Dollar cost averaging refers to investing your money at regular periods, such as weekly, monthly, or quarterly, in items like stocks and ETFs, often referred to as DCA. Most of us have 401k contributions set up at work, and money is routinely deducted from our paychecks and invested in a variety of funds. You've employed dollar cost averaging if you've done that. While this is the most frequent technique of dollar cost averaging, there is another way to go about it. If you have a large quantity of money in a savings account, for example, you can choose to invest it gradually over a period of time. For example, if you have $20,000 in savings, you might invest it over the course of a year, evenly rather than all at once. The main advantage of this technique is that you're not investing all of your money into the stock market at once, risking that the market will crash and your portfolio's value would plummet. Because previous performance is only a piece of data and no one can forecast future results, dollar cost averaging allows you to psychologically put your money in riskier assets, such as stocks, without feeling the risk as much. Lump sum investing. Lump sum investing, on the other hand, is when you put all of your available funds into the stock market at once. It's the inverse of dollar cost averaging in that you don't have to wait to invest. It all flows straight into your selected assets. There is a delicate line between DCA and lump sum investment right now. Allow me to explain. If you're actively hoarding cash in order to invest it later, I'd call that dollar cost averaging. However, you can still make monthly investments and treat them as a lump sum investment. Assume you receive a $10,000 quarterly bonus. You decide to invest your bonus every time you get it. Even if you're making monthly installments, this is still lump sum investing. The reason for this is because you're not saving the money for a rainy day. Who is dollar cost averaging for and not for? Dollar cost averaging is ideal for anxious investors with a low risk tolerance and big quantities of money stashed away in a high-yield savings account. You may reduce your risk by dividing your investment into smaller parts and maintaining funds in a safer instrument, such as a CD. If you can spread out your investment over a longer period of time, you'll also profit from dollar cost averaging. If you invest your money too rapidly, for example for 3 to 6 months, the market may not have enough time to fix itself after a significant upswing or downswing. Who is lump sum investing for and not for? Lump sum investing necessitates a high level of risk tolerance. It's taking a risk. A lump sum investing approach would advise you to put all of your money into your investments at once if you have $20,000 to invest. If you do this, you risk the stock market falling soon, just like what happened in March due to the coronavirus pandemic. Alternatively, it can go up and you win, which is why it's a gamble. So, if you have money to invest and are all right with the possibility of losing it, and you're ready to accept that risk, lump sum investing is a terrific alternative for you. While there is an inherent danger, there's also the prospect of enormous rewards. Consider what would have happened if you had invested $20,000 shortly after the stock market crashed in March. You would have gotten to experience the ride of a substantial market bounce so far. Similarly, if you are concerned about the possibility of losing your investment, or if you prefer to have some extra income set aside for emergencies rather than investing it, lump sum investing is probably not for you. Even if you could persuade yourself to make the investment, those who are internally uncomfortable with it would suffer anxiety and make emotional trading judgments, which is never a good thing. What should you choose? Both yes and no. No, it doesn't matter from a human and psychological standpoint, but yes, it does from a data and statistical standpoint. This is what I mean. I like to compare this reasoning to Dave Ramsey's debt snowball argument. The debt snowball is illogical from a mathematical standpoint. Ramsey recommends paying down the smallest sum first, then the next largest, and so on. This method disregards interest rates, so it isn't really the most rational, yet it works on a psychological level. That is where I believe dollar cost averaging outperforms lump sum investment. Mathematically, it doesn't always make sense. I'll explain why shortly. But it adds a level of psychological safety to your investment plan by allowing you to maintain cash on hand in case of an emergency while also investing some money. Did you know that? Dollar cost averaging, like any other risk-reducing investment approach, such as bond buying, has drawbacks. Simply put, a dollar cost averaging investor will lose out on huge market swings once they are putting money aside for the next cadence deposit toward that investment. The money may have already corrected itself by the time the money is ready to be invested, and you will have lost out on the gain. In the early 1990s, two finance professors conducted research that examined historical stock market data spanning around 70 years. Their research revealed that, on average, someone who invests a lump sum earns better returns in their first year than someone who uses dollar cost averaging and drip feeds their investment over the course of the year. Another recent Vanguard research looked at the difference between dollar cost averaging and lump sum investment in a 60-40 stock bond portfolio in 3 different nations. They discovered that in each market, a lump sum investment resulted in higher portfolio values, almost 2/3 of the time. They ran versions of this test and obtained fairly similar findings.